Good afternoon, distinguished ladies and gentlemen. My name is Bibi Akinyelure, and it's an honor to be your moderator for this Africa CEO Forum Financial Industry Summit session themed Relieving Banks from the Burden of Non-Performing Loans. I certainly hope that everyone can hear me and see me, and I hope you're all doing well wherever you are. Now, the past year has certainly been a challenging one, given that we are still in a pandemic. And here in Africa, just like in many parts of the world, we are seeing the negative impact on our economies. In this session, we will focus on the banking sector, as non-performing loans on the books of African banks are expected to double this year from 2019 levels. So we are asking in this session, is an implosion imminent? And what do we do about this? How do we manage our non-performing loans on the continent? Do we follow the example of North America, Europe, and Asia, where secondary markets allow private banks to withdraw these bad loans from balance sheets? And if so, how can we achieve this on a continent that still lacks this kind of market infrastructure? And when it comes to investment, how do we compete with more developed markets? What is holding back the creation of these types of markets in Africa? And what does the future hold for us? All right, to find answers to these key questions, we are thrilled to be joined by esteemed speakers today and also panelists. We will kick things off with a 7-minute presentation from Subiroa Mains. She is a regional lead for Middle East and Africa in the Distressed Asset Recovery Program at IFC. Now, just to let you know, after we have that presentation, we will then move on to a 30-minute panel, and then we're also going to have a guest today, 8 minutes interview with a guest, which will come in during the panel discussion. We do hope that there will be some time for some questions and answers. Hopefully, we'll be able to get some in towards the end of the session. Right, so let's jump straight in. I would like to welcome our expert, Subiroa Mains. She manages IFC projects in the region, investing in platforms that acquire and resolve non-profit loan portfolios from non-performing loan portfolios from local banks, corporate debt restructuring, special situations, and turnaround of local businesses. She will be giving us insight into the creation of secondary markets for the resolution of non-performing loans, and she will highlight the work that the IFC is doing in this area on the continent. Over to you now, Subiroa, for your 7-minute presentation.
Thank you, Didi. Hello, everyone. It's a pleasure and an honor to be part of the first, I think, ever non-performing loans panel at this Africa Financial Industry Summit. So I would like to introduce the topic. I think it's very important, as you said, Didi, to discuss and to bring this topic into the conversation on the financial, with the financial sector, especially because of the moment in which we are living in, right? I have a brief presentation. I don't know if I can upload it or, okay, here we go. So to introduce what I'm sure it will be a very interesting session with the panelists that we have today. I would like to illustrate, since this is the first NPL panel at the summit, is to introduce why it's so important to address the distressed assets, non-performing loans, that they cover the whole spectrum, as you described, Didi. When we talk about non-performing loans, we talk about corporate debt restructuring, special situation, etc. So why is this is so important, not only for financial stability, but for economic recovery? So, well, as you can see, I try to illustrate with a cycle where we are today. There is a moment of economic deceleration and rising unemployment. This is going to create or to have a direct impact on the non-performing loans. These non-performing loans will increase and will require higher provisioning by the banks, and that will create, it will limit the resources of the balance sheet of the banks. that in turn will reduce their capacity or limit their capacity for new credit. No, and this reduced lending will again slow down the economy, will generate unemployment, and will have a direct negative impact in the economy. So as we can see, this economic slowdown, increasing number of NPLs, reduce the bank capital, and limits the new lending, is creating a negative feedback loop in the economy. So effectively managing these distressed assets of higher non-performing loans will be critical to break this loop and to support economic recovery. Just to, as you mentioned, I mean, this sector in secondary NPL markets we see some activity across in some countries, but they need to be yet to be developed, right? So, for instance, as you mentioned, for instance, in Europe, just to give an example, in some markets where the secondary NPL markets are developed, like in Europe, the European Commission presented a very specific strategy to support the further development of these secondary NPL markets, meaning facilitating the NPL sales or make the NPL sales more dynamic from the banks, which the core business is lending, to a third-party vehicles that their core lending is restructuring and recovering, restructuring those loans. So let's put some numbers. In the map you see in the 54 countries in Africa, it's estimated that there are more than 60 billion of NPLs. This is based on public available data, and it yet doesn't reflect, as you said, it doesn't reflect yet the future build-up of the NPLs as a result of COVID. We don't see the numbers, that the darker the color, the largest volume of NPLs. If we move to the next slide, more importantly, in my view, than looking at the volume, is looking at the NPL ratio, which is the amount of non-performing loans over the total outstanding loans at any particular point in time. So what we see across Africa, the map looks darker across countries. So there's a 12% average NPL ratio in the continent. And again, based on data that still doesn't reflect the impact that COVID will have. And in our approximately 30 countries, this NPL ratio is about 10%. So this creates, it requests a solution that for the banking industry, to support the banking industry, so they can have, like their peers in other developed markets, an important risk management tool, so they can offload part of the NPLs or the portfolios that they decide, depending on the needs of the specific needs of the balance sheet, they can offload a part of the NPLs and have this risk management tool to focus on their core business, that is lending, and unlock the capital that they needed to lock or provision for these non-performing loans. So because of this need, creating secondary markets for NPL resolution has become an important part of IFC's development agenda in Africa. As the markets, as you mentioned, as the market have not been created in most jurisdictions, the first natural step is to make an NPL market assessment. And that includes to make, without going into in the specifics, which I'm sure the panelists will touch on later on, it's making us an assessment of the regulatory and legal frameworks that allowed for the non-performing loans to be transferred from the banks to third parties. So here, in doing so, IFC is engaging with the numerous stakeholders in each market that include central banks, banking industry, legal firms, obviously, some investors that can be interested in the market, some local servicers, accounting firms, to assess, the whole NPL market, looking at the legal and the regulatory framework, but also looking at other aspects such as the type of non-performing loans and the specific needs of each country. For instance, if we look at Nigeria, it's mainly corporate non-performing loans. If we look at other markets, it's more a mix. So the assessment has to be done at a country level to assess the challenges, in the enhancements that are needed. In parallel, we are looking at the servicing capacity. This means that, the servicers are the companies or asset managers that are going to be performing that restructuring of the non-performing loans. While capital to this industry can come from abroad or from country to country, servicing is a very local affair and has to be done locally. The restructuring is performed by local companies. So in Africa, I mean, it is very important to develop and to support the development of this sector, no, in the continent. For that, IFC provides long-term support. This is a long-term investment. The restructuring takes time. So we provide a long-term support to local services through equity investments in the companies. And the last point that we are also looking at is, which is, again, is crucial for the development of the market, is the capital. It's very important that there are enough pools of capital available to have enough capacity to acquire non-performing loans from the banks, and also for corporate restructuring, etc. So what we see in this space is that while in other markets there are very specialized international investors, they are more focused in markets where the volumes are much larger, and perhaps the legal and the regulatory frameworks are more favorable to the markets to develop. So how, to your question, Didi, how do we attract, others to come? So what we are doing is we are acting as an anchor investor in some sizable platforms, or some vehicles that are acquiring these non-performing loans, and together with the partners or with the co-investors, trying to mobilize more capital to come along and make the market more dynamic. So it's a long journey. I mean, we have been doing this for a while. Now the need is bigger than ever, no, if I can say, because of COVID. But what we see as well is there is a lot of interest from regulators and from banking industry and from the numerous stakeholders. And I think we are in the right path to make it happen. So I will stop here and pass it back to you, but happy to take questions later on. Thank you.
Thank you so much to Subira Mains for your presentation, which of course sets the scene for the conversation with our panelists today. So I would like to welcome our panelists, and I shall tell you who exactly they are. Welcome Peace Uwase. Peace is Executive Director of the Financial Stability Directorate at the National Bank of Rwanda. We also have Constant Nzi, who is Group Chief Risk Officer, African Guarantee Fund. Constant has over 15 years of risk experience in financial services and investment banking, with great exposure having worked in Africa and Europe. And investment banking at Absa Group. He is responsible for the investment banking division across Africa. And panelists, welcome to you all. And I'd like to just remind you to keep your answers tight. Within 3 minutes would be great, as we, of course, would all like to get an opportunity to express our views this afternoon. So first of all, I hope you're all there. Yes, I can see you all. All right, so let's start with the facts from over $60 billion of non-performing loans on the continent, he mentioned, with a 12% average NPL ratio. And the expectation is that we're likely to see even higher levels of NPLs due to the pandemic. So I'm going to start with Peace because, ladies first. I would like to get your assessment of the situation. And given the economic slowdown, what, in your view, is the probability of an implosion? Peace.
All right, thank you, Didi. Thank you for having me. So my thoughts on an implosion. First, I think that maybe an implosion might be a bit alarmist. But I do agree that we do have real challenges, and we need to face them squarely and soberly. Indeed, like the presentation showed, African economies have been significantly impacted by the pandemic, especially those that highly rely on natural resources and tourism. When you look at when you compare the growth forecasts, GDP growth forecasts at the beginning of 2020 and what was actually realized by end of year, you start to see significant gaps. Countries like Cape Verde, Zimbabwe, Botswana, the Republic of Congo, and Seychelles all experienced variances above 10%. And when you look at the larger economies, Nigeria, Angola, you also have significant variances, about 6.2, 5.5% respectively. Now, if you focus now on those countries that heavily rely on tourism, the forecast even become more concerning. In January 2021, the World Tourism Organization reported that recovery for this sector particularly is not expected to reach pre-pandemic levels before 2023. When you look at the October 2020 Africa Pulse report, again, same prediction. GDP for the continent was expected to shrink by about 3%, a little over 3%, and this is predicted to be the first recession in over 25 years. Growth prospects for 2021 were looking a bit positive. We're looking at growth prospects of about 2.1% across the continent. But with the second wave of the pandemic in most of our trading partners, the emergence of new variants of the virus, as well as the slow rollout of vaccinations, that growth perspective is also kind of hampered, right? 2022 is expected to be more in positive territory, but still below population growth. So the growth prospects don't look very good. So that said, indeed, this is an environment that is ripe for an expectation for an increase in NPLs. And historically, we've seen that, as GDP growth slows down, then NPLs start to pick up. For example, during the 2009 financial crisis, GDP was nearly cut in half between 2007 and 2009, from nearly 8% to just over 4%. This caused an increase in NPLs, but what we've seen is that even though there's usually an inverse correlation with NPLs, that usually takes a lag effect. So we saw that as a result of the 2008 financial crisis, NPLs started to pick up in 2020, increasing from 7% in 2007 to about 8.6% in 2020. So we do expect NPLs to increase significantly. But I would say that an implosion, in my view, is kind of extreme, kind of alarmist. Thanks, Didi.
Thanks so much for that piece. I'd like to get your thoughts as well on this, Constant. What would you say has prevented an implosion in the short term, and how do we start to tackle this in order to prevent an implosion in the medium to long term? Constant.
Okay. Thank you, Didi, for having me. So I think before going to the implosion part, I would like to stress on something which is missing in the picture, which is, today we have NPL, but what is the potential impact of this NPL on the balance sheet of the bank? So what is very important to stress on today is the liquidity of this NPL. So if you take a database from World Bank, you will notice that in high-income countries, you have the time for recovery, which is about 1.7 years. Mm-hmm. But when it comes to Africa, we are around 3 years for recovery. So we have another dynamic coming on top of the fact that we have huge NPL amounts, and we may expect an increase of this NPL amount. So we need to tackle, so it shows us how it's important to tackle this NPL issue. The second aspect I want to put on the table is the recovery on this NPL. The same comparison, when we take developed countries, we take high-income countries, the recovery rate on NPL is 70%, around 70%. In Sub-Saharan Africa, we are around 20%. So we have 50% gap in the recovery of the NPL. So we have two problems on the NPL in Africa. We have the high level of the NPL compared to other countries, and we have the low recovery rate and the long time to recover the NPL. So this was to complete the picture on the NPL and on the NPL part. And then on what can we do? What can we do to avoid the implosion if it may happen? For us at AGF, we put in place a guarantee called COVID guarantee, which started a few months ago, which will allow banks to come to AGF to restructure the NPL. So this is thanks to all the measures which have been put in place by central bank to restructure the NPL of banks, because we know that I work in the SME sectors, and in the SME sectors, one of the huge problems the SMEs can encounter is the liquidity. So allowing them to restructure the facility will help them to solve, for now, the NPL problem. And then going in the reason of our panel today, why not put in place the secondary market, which I can only strongly recommend.
Okay. All right, so I'd like to bring David in at this point to get your assessment of NPLs on the continent, and interesting points there for from Constant. We have high levels of NPL and low recovery rate. So perhaps to get your thoughts on that, and also I'd like also for you to dwell on the fact that we are looking at this as a Pan-African issue that requires a Pan-African solution, and so. Another question I have for you then is, should we be more country specific in our assessment of NPLs, David?
Didi, thanks for that. And I think Peace made some very good points right up front, which actually talks to that. I think we've always got to be careful, and we operate a business which is across 15 African countries, but of course Africa is made up of 3 times or more than 3 times that. And so you really have to think about it not as painting Africa with one brush. There are some very different dynamics. We've talked about those countries that are quite heavily dependent on commodities, and we saw those that are dependent on oil and gas. When we saw the once in a lifetime, I think in April last year, where actually the price of oil was negative. It's quite unbelievable to think that something like that can actually happen. But then you've seen the oil price rebound, and you've seen some of the markets, the likes of Nigeria, start to recover quite quickly. The hard commodity producers of Zambia as well, you've seen you've seen some rebound there, and then, but I think what's going to drive it is the sectoral themes. So we talked about commodities. The other is around tourism and leisure, and places like Mauritius, which are still in hard lockdown. I think their path to recovery is going to be very, very long. But I think we need to then separate. Once we look at that in different regions, then we've got to look at some of the dynamics in them. And so for me, what are some of the dynamics where you see there are a lot of the big lenders, I think Constant referred to it, are actually pretty well capitalized. They have the strong regulators, often where they're based, and they also have strong access to capital, both access to the bond market as well as to the equity market. So should NPLs start to drift significantly badly, my view is that a lot of these big regional banks, which are a lot of the big lenders into Africa, actually have access to capital markets to repair their balance sheets. And I think the last one is where we've seen some positives is where you've seen the spirit of partnership in certain markets where regulators have been on the front foot, and there's been some very strong calls or decisions made by regulators in partnership with banks, in partnership with investors, and in partnership with shareholders. And I think that's gonna drive the recovery. So going back to, I think, the point which Peace made, we don't foresee a big implosion, because I actually think there is a very large diversification across the continent, and we'll see different markets recover at different pace over the next couple of years.
All right, interesting point there, David. And I think if there's one thing that we're all saying, it's that an implosion may not be imminent, but at the same time we must be cautious. And one of the things that one of the strategies that or options that we may have in terms of tackling this is by having an NPL secondary market. So, David, I want to stay with you. Do you think that when you look at what we have now on ground, do you think that this NPL secondary market will see the light of day in the future? So in other words, is this something that is possible to get right in Africa?
Look, I think you probably need to break down the NPLs into 3 buckets. One is your consumer credit, then you have your SME, small to medium enterprise, and then you have your large corporate / sovereign or sovereign linked. Because I do think when you think about an actively traded NPLs, you've got to think about the basket of securities or debt which are available to distribute. That's the first point. The second is, unfortunately, as much as many people have tried, Africa does not have deep domestic liquidity when it comes to either active primary issuance in terms of debt capital markets or secondary loan trading. We don't sit in many markets where there are big institutional investors or funds which are actively trading. So to think we're going to go from where we don't have a deep DCM or debt capital markets, we don't have a deep loan trading market, to almost leapfrog to get to the point now we have in an active secondary loan trading market, for me, I think it's quite a big jump, right? And so where I think we may see some activity, and we're starting to see it already, is going back to, as I try to tranche the NPLs in your large corporates, particularly those that are where the credit is dollarized, so it's in a hard currency, it potentially could be liquid. There you are seeing some participation coming in from global hedge funds. And where they're looking at it, they're looking at it through two lenses is what we're seeing. We see either it's a trade where they can, for example, buy at 70 and sell at 90, so there's liquidity in the actual credit, or they're looking at it where it's unfortunately in some of the hedge funds which we've seen, it's almost a loan to own strategy. So in other words, if we can get our hands on this particular grouping that has very strong undervalued assets, is there some mechanism for a debt to equity swap? Now, that's probably not the type of investors who want to see too much of it, but I do think if we're going to see active trading, it's going to be across big corporates that are going to distress, and predominantly in hard currency, because then you start to attract a global universe. We've always seen there is not a big investor following for local currency credits on this continent at this point.
I want to bring Constant in, to get your thoughts on that point, and also what would you say is holding back the creation of these secondary markets in Africa in your view?
So my point of view is to support what Zubeira said in the presentation. So we have a very strong preliminary condition before going there. We have today a legal and regulatory framework to put in place before moving there. And it's a step which may take time. So we have to set up in all these countries interested in the secondary market a very strong recovery framework, a very strong recovery legal environment. Then the second point, which is also very important to put on the table, is the data. So we can decide to move today on the secondary market, but then we need to price this product, because who says buying and selling says a price, a fair price, and a fair price will be based on all data which will be taken into account in the valuation of this NPL. We know that one of the reasons why we have a so low recovery rate on the collateral in sub-Saharan Africa is the collateral database, something quite simple, but it's very difficult to find in most African countries a strong collateral database which is reliable and on which we can let's say trust to compute any pricing. So in my mind, these two very strong first steps have to be met before even talking about the liquidity to be brought in the market and all the means to be brought in the market. For sure, it's a very interesting product. It's a very interesting project, but we need to set up the legal environment and the let's say the data mining.
Yeah, and I mean, just as David pointed out as well, as you're saying, this is something that is difficult to leapfrog, and it's quite a big jump. But I want to get your thoughts very quickly as well, Peace. When it comes to the creation of this secondary market for NPLs, are you less optimistic or more optimistic?
I think my view is very similar to what David and Constant have shared. I think that first, in determining for for the establishment of, let's say, bad banks and their funding, I think there comes a question with regard to whether those should be publicly owned or privately owned, considering the period that we're in right now. If they're publicly owned, do governments have the fiscal space to actually fund the establishment of such bad banks? With competing priorities for healthcare, for education, and things like that. So, the public space becomes a little bit complicated. On the private side, I guess looking at, looking at the season that we're in, packaging non-performing loans, looking for investors either domestically or foreign, it's a tough sell, right? It's a tough sell considering the period that we're in. So I think, but what I found interesting, I think in the presentation that Zubero made was reference to work that is being done by the like of IFC and things like that. So I think that the possibility of public-private partnerships is something that can be explored to unlock this space. In terms of regulatory framework, same opinion. I think we do have work we have our work cut out for us in terms of our national insolvency regimes, in some instances that overly protect borrowers from enforcement measures, skills and sufficiency of numbers of staff in the judiciary process for such recoveries. There are quite a number of legal impediments, and I think that the earlier we start working on things like this, the sooner we can open up space and salvage some value out of the expected increase in NPLs.
Right. At this point, I would like to bring in our guest, Mustafa Mourahib, because I think we're all pretty much saying the same thing here. It's a tough sell. When you consider the period that we're in, and also when you also look at some of the other challenges, from the regulatory framework, to the skills, that are not, on the African continent, or we don't have enough of these skills that actually know how to make this work, and data. So these keep coming up, and also, like David said, the fact that we're dealing with 54 countries with not just differences in portfolio sizes, but also differences in legal and regulatory framework. So let's welcome Mustafa Mourahib. He is the managing partner of Clifford Chance's Casablanca office and co-head of Clifford Chance's Africa practice. Thank you and welcome. Thanks for joining us, Mustafa. So I'd like to get straight into our interview. Now, I want to ask you this: what is it about banking regulations as a whole and the legal and regulatory framework that makes it difficult to create a secondary market for NPL resolution in Africa? Oh, Mustafa, you may have to unmute your.
Thank you, Didi. Thank you very much. You're right. I have to unmute. That helps a lot. So sorry for that. I don't think it's about the regulation itself where there is a difficulty. I think that David mentioned earlier that we have very strong regulators. And the banks are very well capitalized and quite robust in terms of financial stance. The difficulty we have is mainly the fact that you don't just decide to create a secondary market for NPLs. Mm-hmm. That's right, you need to have the regulation, and we will discuss about the regulation and what type of regulation you need. But also you need to have a more dynamic and way to anticipate the management of the portfolio from the banks. The banks need to consider at earlier stage what to do and how to organize themselves in relation to NPLs. This request and require a total change of mind. We are a lending market with usually small capital markets, depending on certain countries where you have a bigger capital market. But in reality, you have the market of banks lending to clients. But the idea of anticipating the situation of non-performing loans is something that is new and that will require an anticipation in how to identify those NPLs and how to find the right structure. So I think it starts first with the bank willingness of anticipating and clean the balance sheet. And it is difficult because the way the banks functions and develop in Africa, and most of the banks are, focused on results, and the recognition of the loss takes a long time. Because they rely on security, they took security, etc. And so the recognition of the loss by itself takes a long time to the bank to react. Once we have this change of mind, you have to have the regulation. And for example, we all know that NPLs could be dealt, and we have been working with IFC and others to try to structure a transaction where a bank would be able to transfer non-performing loans to vehicles of securitization vehicles. Morocco has adopted the most innovative, probably in the world, the most innovative regulation in terms of securitization, which allows a lot of structuring. So we can decline that and do that in other countries, and you have this type of regulation allowing that. The third thing, is the fact that you also need a capital market. You need to have a financial market developed and a deeper financial market, and it's not always the case in all the other countries. The first two issues, the behavior vis-a-vis NPLs, the regulation, we can deal with that. But the deepest of the financial market itself, depending on the country, depending on whether it is an oil and gas country or more financial country or more diverse economy, this is a difficulty. To have this financial market is key, because the investors into this type of NPLs are not going to be the same banks, because they are cleaning their balance sheet, not to structure on the other side vehicles where they will invest to buy those NPLs. They will tackle that through insurance companies, pension funds, etc. And this is where this financial market is important, because the tickets are too small for the bigger player in the international market. So it has to come from the local market, and it has to come from the financial institution on those markets.
All right. Now, I want to tap into what you mentioned there with regards to what's being done in Morocco. Perhaps we could have more insight into that, and what lessons could the rest of Africa learn from NPL securitization efforts in Morocco?
Yes, well, first of all, we still do not have an NPL transaction, a securitization of non-performing loans. We have a developed market on securitization, but in particular, we have a regulation under Moroccan law that allows a lot of structuring and a lot of flexibility. This has been done with DFIs of the world like IFC, EBRD, and others. And the World Bank, working on this regulation in order to allow the most possible flexibility. There is a possibility to transfer not only non-performing loans, but there is also the possibility to structure a transaction where, in advance of non-performing loans, you can also free up some capital for the banks through synthetic securitization. And synthetic securitization is just a possibility for a fund, a securitization fund, to issue securities in order to finance a guarantee that will guarantee a portfolio of loans in case of loss. So the bank that is benefiting from this guarantee on its portfolio is allowed to go back to the central bank and say, well, I need less tier one capital because I have this portion of my portfolio that is guaranteed. This free up the possibility for the bank to lend again and to reduce pricing. But all of this, and you also have the possibility to create a bad bank, including in Morocco, through the existing regulation. But all of this will happen only if you have the human resource. So the difficulty we are having is that the technology for structuring the non-performing loans is outside Africa. The regulation, you can work on the regulation and adapt the regulation because we have very good regulators in Africa, and they're probably one of the best in the world in terms of best in class in the world in terms of not only the regulation but the way they interact with the banks. But the regulation can change, but you still don't have the technology. So the only way to make it happen is with the help of the like of IFC and Zibera mentioned some transactions in South Africa in order to help creating and show to the market that it is possible to create these structures. Otherwise, because the technology is not on the ground, there is no need to modify the regulation because no one is going to ask for it, because no one is asking for this type of structure.
Mm. All right. I think that's a good place to leave it. I mean, I want to go back to the panel, but thank you so much to our guest, Mustafa Mourahi. Thanks so much, Mustafa. All right, so I hope we have our panels back there. So just a few interesting points that Mustafa made, so talking about how, the challenges are not just to do with, regulation, we have, very unique challenges like, technology for structuring, being outside Africa, the fact that we need a deeper financial market, and, we need to be looking at this from maybe a point of perspective of local investors and maybe less international investors. And that's something I want to bring you in on because, Mustafa, Mustafa mentioned, to me, he's mentioned three key things that are, probably needed to, successfully create this secondary market. He talked, besides regulation, he talked about needing a catalyst like IFC to help, with issues like, technology, to help structure, and, a local players or a local market to buy. Interesting that he mentioned local players, and it's also something that we saw at the start with the IFC presentation, mentioning that international investors in NPLs are more focused on much larger and more developed NPL secondary markets. So I want to ask David this, and given that, there's a small ticket sizes on offer here in Africa, do you think that we stand a chance at competing, or do you agree with Mustafa that, we really should be looking at this from a perspective of local investors? David. Hi, David. David, you might have to unmute. Hi, David.
Yeah.
Yeah. All right. I can't hear David. I'm not sure if it's only me. Can we just try that again?
Can we try now?
Yeah. I can hear you now.
Yeah. So I think that the points are very well made. So how do you create a more appetite domestically for ultimately the assets? So I agree. We need the framework, we need the structure, but ultimately you need people to actually buy the risk. And that is a challenge in many of the domestic markets, as I said earlier, because you simply haven't had that active primary issuance, ECM, as well as secondary loan trading. So I think the success is going to have to be a hybrid, right? In some of the markets where we do have more deeper capital markets and bigger institutional investors that are starting to understand credit as a separate asset class. And when I talk about markets, I'm thinking of markets like Nigeria, markets like Kenya, markets like South Africa. I think you've got to try stimulate it. And then in other markets, I think it's going to be a lot more difficult. And I think that's where the roles of perhaps the IFC can play a role, where it provides some form of first loss, could provide some form of wrapper, which then goes to where I think Mustafa was saying is, are there some structural enhancements that can allow for a broader investor base to actually participate.
All right, now let's bring you in on this as well. Peace, comments on that interview I had just now with Mustafa, and also how do we make this an attractive proposition for investors? Peace.
I think that, like I said in the beginning, it's a tough sell, yeah? So for it to be an attractive investment, there has to be a view that they can make money, that there is a return, a potential return on investing in these non-performing assets. What that takes, in my view, is that first you need to ensure that the appropriate haircuts are being taken at the onset by the good banks, and which is where probably the reluctance usually comes up, the reluctance to release these non-performing assets, because they don't want to take these haircuts and negatively impact capital or their own performance. So I think that tough balance that allows for those haircuts to be made early on in time, that requires also that the good banks are recapitalized at the time that this transfer is happening. I think that is critical. Then in that case, then there is a promise that you can actually salvage this at a higher value. The other thing, in my view, is that. Like David said, I strongly agree that to make this work, there has to be partnerships, not just, I think, looking at it domestically only, and the ability to raise patient capital in times of potentially a financial crisis in our markets is tough. So I think that to make this work, partnerships are going to be critical. It may be a tough sell, but I think even positioning the issue at let's say regional level, maybe continental, may be too much of a stretch. But for example, within our East African community, come together and actually package this as a region instead of looking at it as a just Rwanda, Burundi, Uganda separately. But if you pull it all together, I think that you have a better sell.
All right, and let's bring you in as well, Constant. What are your thoughts on this? Can investing in African NPLs be profitable?
Yeah, definitely, Didi. I think it's where we're coming from, and if we avoid this game from, I'm sorry for the bankers, this game from the bankers to take the loss as late as possible, it's something which can be totally profitable, because I gave a figure in the beginning of the presentation about the recovery rate, which is only 20%. So meaning that at the end of the day, the bank can recover only 20% on average in Africa on the non-performing loan. So they will buy time to take this loss, but at the end of the day, over the 3 years, they will have this loss. And the second point, the second reason why we think that it can be a profitable business is the economy of scale, because we are mentioning, all the panelists, Peace and David, were mentioning the fact that we need a big initiative. We need a lot of inflows to think in terms of region and not only in terms of countries. So by putting the effort together and creating something big, focusing on big volume, we can have something more efficient than when the banks process to the recovery internally. So the outsourcing here, it will be a great impact. The information, like the democracy on information, which will be in place because of the secondary market, will also have a very positive outcome on the NPL. So in our mind, it can clearly be a profitable activity.
All right, let's leave it there. I was hoping that we'll be able to get some questions in, but we are slightly just about 5 minutes, or just less than 5 minutes now, to the end of the session. A lot has been said. It definitely looks like this isn't something that we're going to be able to do overnight. there's so much to do, and lots of good points were made, from having regional partnerships to regulation, technology. I think I'd like to give each one of you maybe 30 seconds to just sort of round things up and just give a final point, or if there are any key points that you'd like us to take away from this. So key words or key points. 30 seconds, and I'll start with David. David?
Yeah. So some reason it just takes a while to come off mute. I think the way this is, we're going to get some momentum out here has to be in the spirit of a partnership. So I think that's my first point, is that, and we've seen it already where banks and regulators work together. Banks, regulators, and investors and institutional investors and shareholders work together to try get some of this moving quite quickly. I think the spirit of partnership has to drive this. And I think the other is a very important point, which one of my colleagues mentioned, is that I think banks also need to change their DNA a bit. Banks have historically had this buy to hold strategy when it comes to credit. We'll lend the money, we'll work it out, and we'll work it out till the death, and then we'll see what happens after that. I think to get this right, there has to be quite a big give from the banks to say, actually, my core strength is often lending money, making those decisions. I don't necessarily have the capacity to actually collect on all of these debts, particularly in a period where NPLs are elevating. So I do think there does need to be quite a bit of give and take, and I think the banks there needs to be a bit of a DNA shift within some of the organizations.
All right, and Constance, 30 seconds from you.
Okay, thank you, Didi. So yeah, I think what you have been trying to demonstrate, it's the way to go. So secondary market is the way to go, and for that we all need to understand that it will be a win-win partnership. Win-win partnership between the banks and the potential investors who are coming in the game. So yes, all steps have been clearly and extensively mentioned by all panelists and all participants. So we should try to implement them and see how it goes.
All right, and Peace?
I think in closing, I would say that the task before us is indeed a difficult one, but it's not impossible. The blueprints are there. The blueprints for success are there. So we just need the tenacity and teamwork to build on such experiences to make this work for our countries, for our economies, and for the continent.
Thank you so much. So I think that's a good place to leave it. There you have it, ladies and gentlemen. On behalf of the Africa CEO Forum, I would like to thank our expert, Sabira Mains, our guest, Mustafa Mourahib, and our panelists, Peace Uwase, Constant Inzi, and David Wenwick. Thank you for sharing your views on the resolution of non-performing loans in Africa and your thoughts on the creation of secondary markets for economic recovery. Now, ladies and gentlemen, and all our viewers, there are more sessions coming up as part of the Africa CEO Forum's Africa Financial Industry Summit. The rest of the program will appear on your screen after this, so stay logged in to watch the next session. Thank you very much, everyone. Thank you.